Credit rating is a tool used by financial institutions to evaluate the creditworthiness of individuals or companies. The concept of credit rating is not new, but it has gained significant importance in the modern era, where credit has become an essential part of economic activity. The credit rating system is designed to provide lenders with an assessment of the likelihood of a borrower defaulting on their debt. Credit ratings are assigned by credit rating agencies, which are independent organizations that specialize in evaluating the creditworthiness of borrowers. What is a credit rating? A credit rating is a score assigned to a borrower based on their creditworthiness. Credit ratings are determined by credit rating agencies, which evaluate borrowers based on their credit history, financial statements, and other relevant factors. Credit rating agencies assign a score to a borrower based on their assessment of the borrower's likelihood of defaulting on their debt. The credit rating is a measure of the borrower's ability to repay their debt. Credit rating agencies use a standardized rating system to evaluate borrowers. The rating system is usually based on a letter grading system, with A being the highest rating and D being the lowest rating. Borrowers with higher credit ratings are considered less risky and are more likely to receive favorable terms and lower interest rates on their debt. How credit ratings are determined? Credit rating agencies use a variety of factors to determine a borrower's credit rating. The factors used by credit rating agencies vary, but they generally include the following. Credit history. Credit rating agencies evaluate a borrower's credit history, including their payment history, credit utilization, and length of credit history. Borrowers with a long history of making timely payments and low credit utilization are more likely to receive higher credit ratings. Financial statements. Credit rating agencies evaluate a borrower's financial statements, including their income statement and balance sheet. Borrowers with strong financial statements are more likely to receive higher credit ratings. Industry and economic factors. Credit rating agencies evaluate industry and economic factors that may impact a borrower's ability to repay their debt. For example, if the borrower operates in a volatile industry, they may be assigned a lower credit rating. Legal and regulatory factors. Credit rating agencies evaluate legal and regulatory factors that may impact a borrower's ability to repay their debt. For example, if the borrower is subject to regulatory action or litigation, they may be assigned a lower credit rating. Credit ratings have several benefits for both borrowers and lenders. Some of the benefits of credit ratings are: lower interest rates. Borrowers with higher credit ratings are more likely to receive lower interest rates on their debt. Access to credit. Borrowers with higher credit ratings are more likely to be approved for credit. Enhanced reputation. Borrowers with higher credit ratings are considered more creditworthy, which can enhance their reputation and improve their ability to do business. Reduced risk. Lenders use credit ratings to assess the likelihood of default on a loan, which can reduce their risk of financial loss. Standardization. Credit ratings provide a standardized measure of creditworthiness, which can help lenders make more informed decisions. Credit ratings also have several limitations. Some of the limitations of credit ratings are: limited scope. Credit ratings only provide a snapshot of a borrower's creditworthiness at a specific point in time. They do not take into account future economic or industry factors that may impact a borrower's ability to repay their debt. Biases. credit rating agencies may be biased in their assessments, which can lead to inaccurate credit ratings. Lack of transparency. Credit rating agencies may not disclose their methodologies, which can make it difficult for borrowers to understand how their credit rating was determined. Inconsistency. Credit rating agencies may assign different credit ratings to the same borrower, which can lead to inconsistencies in the credit rating system. Lagging indicators. Credit ratings are lagging indicators, meaning that they reflect past performance rather than current or future performance. This can make it difficult for lenders to accurately assess a borrower's current creditworthiness. Cost. Credit rating agencies charge fees for their services, which can be costly for borrowers, especially for small businesses or individuals. Credit ratings have a significant impact on the borrowing and lending market. Borrowers with higher credit ratings are more likely to receive favorable terms and lower interest rates on their debt. Lenders use credit ratings to assess the risk of lending to a borrower and may require higher interest rates or collateral for borrowers with lower credit ratings. Credit ratings also play a role in determining the cost of borrowing for governments, corporations, and financial institutions. In addition to their impact on the borrowing and lending market, credit ratings can also impact the broader economy. For example, credit rating agencies may assign lower credit ratings to a country or region, which can lead to higher borrowing costs, reduced investment, and lower economic growth. Credit rating is an essential tool used by lenders to assess the creditworthiness of borrowers. Credit rating agencies use a standardized rating system to evaluate borrowers based on their credit history, financial statements, and other relevant factors. Credit ratings have several benefits, including lower interest rates, access to credit, enhanced reputation, reduced risk, and standardization. However, credit ratings also have limitations, including biases, lack of transparency, inconsistency, and cost. Credit ratings have a significant impact on the borrowing and lending market and can impact the broader economy.